Now let's talk about assumable mortgages. If the seller of the house has low rate like 2.5, you could possibly assume their loan on FHA, VA, or USDA loans. Now let's say you're buying a $450,000 house and seller owes $350,000 on their current mortgage. The seller owes $350,000 on their current mortgage with their lower interest rate. That is the only amount that you can assume. So the difference is about $100,000. Now the buyer has to come up with that money to assume their loan, since you cannot add any money to the seller's current loan. So what are your options? Well, you can get a second loan at $100,000, but the second loan rate is going to be high, like 12 to 14%. $350,000 mortgage at 3% interest rate is about $1,472 a month principal and interest. And $100,000 mortgage at 14% interest rate is at $1,154 per month, giving you a total payment of $2,626 per month. $450,000 mortgage at 7% interest rate is about $2,963 per month, principal and interest. At 5.5% interest rate on $450,000 mortgage, your monthly payment will go down to about $2,537 principal and interest. Well, people will probably go, why can't I just refinance the second trust? The second trust rate will never go down to 5.5. We're probably looking at 10% best case scenario. 12% is probably going to be norm, or 11%. Now, second trust is much harder to refinance. And then trying to get assumable loan through the lender the seller currently has is going to be a nightmare process. So, is that worth getting an assumable loan, getting through all the trouble, or can you refinance later and make things a lot easier for you and your family? Have a great Monday, and see you next Monday.